My name is Colin Rezek. I'm from Vantage Capital in South Africa, and I'm here to talk about mezzanine funding in Sub-Saharan Africa. So today we're going to talk a little bit about the history of mezzanine, how it started in South Africa and how we moved it into the rest of Africa, some of the industry participants, just an overview of the company, the proposition, where mezzanine works and how it works in Africa, some of the uses, some of the opportunities, and finally a summary. So in South Africa, I think the mezzanine really came into play with the lower interest rate environment. Generally, there were higher interest rates where senior debt at one stage was in the 20s, and it was quite a short period, but when it moved back into the mid-teens and below, that's when it became an opportunity to use mezzanine funding in transactions. I think there's been a consolidation of mezzanine. The first fund was a listed fund, which didn't really work, and they really had a different focus, either stretch senior or quite risky, almost equity type transactions. It was a Rand Merchant Bank fund and basically called Makalani, and that fund has been delisted. The other fund was Mez Partners, which came out of a Brait, the South African biggest private equity fund. And they also now have been bought into an insurance company and are now doing more stretch senior. So I think that people really doing mezzanine and focused mezzanine are only ourselves. So we've become the dominant player, 300 million under management with another 300 being raised by end of the year, maybe early next year. The rest of Africa, I think it's very undeveloped asset class. The few people who are doing it are the development funders and some of the private equity firms, but really more as I would call it a stretch senior or just a layer to fill the gap. I think our focus is going to increase into Africa, and we'll talk about why in a few moments. So some of the industry participants, so there's ourselves, there's Makalani, as I mentioned. Even though they have delisted, they are looking at raising another fund. There's 46 Parallels, you're here today. I have them as a fundraising. I'm not sure if they have raised their mezzanine fund. CDG, it's a small captive fund in Morocco. And we also have in Central Africa a small SME type mezz fund. Greylock Capital, also fundraising. Helios and Jacana were doing a fund with the DEG, and they've actually ceased fundraising on that fund, I think abandoned it. And finally, Sahel Capital still fundraising. So as you can see, there's not a lot of people active in the market, but there are a lot who want to come in because I think they are seeing the opportunity there. Just a quick overview. We started in 2001 as a small tech fund and doing one or two proprietary investments, raised our first fund in 2006, second fund was 2009, and two businesses we've gone into to expand our offering is more on the credit side. There's a renewables debt fund, and we're also looking in the debt capital markets division in the private credit and trying to establish credit funds, because I think that internationally is becoming very popular, where pension funds have an allocation for private debt, but they don't have access to finding the paper, and you coordinate that. So fund under management at the moment is around 600 and hoping to get close to $1 billion early next year. These are just some of the deals that we've done in South Africa. I think early on people spoke about geographies and they spoke about sectors. And I wanted to talk a bit about it, but I thought let me wait till I get up to and explain where. Our view is, yes, there is a need for, let's say, sector funds, either be it mining, be it healthcare, be it education, across the region. So there are some of those funds. We're more agnostic. We look at all industries. But I think geographies, I think there are 2 points that I'd like to highlight that I believe is the way to do it. First is the ease of doing business in different countries and being in the quasi-debt, quasi-equity, where rule of law is very important. I think you have to look at countries where the ease of doing business is manageable. And there's been some terrible stories that I'm sure you've all heard where governments just take over businesses or cancel contracts, etc. So I believe you've got to look at the IFC has an index, and I think the top 3 quartiles definitely are the areas to play in. And if you do play in the lower quartiles, at least have spread where that business might operate in that country but does operate in other countries in, let's say, more favorable jurisdictions. Second thing, I believe you must have local knowledge. So you can see people we have looking after Ghana is a Ghanaian. Even though he sits in South Africa, he goes up to Ghana every second month. Same with Nigerians, same with Kenyans, same with Botswanans. So that's what we try to do across the region. So two things: ease of doing business, countries you feel you can, rule of law applies. And secondly is people with country knowledge. I think we've seen some very, let's say, horrific stories of people coming in there, spending a fortune and being blown out very quickly. And if you ask locals, and they said if they'd just asked me, I would have advised them very differently. I think governance is very important, and just quickly on the right, we do have an independent, we believe an independent advisory board or more an investment committee is very essential, because investment committees mustn't have deal fever, and they must be able to look at it completely from the outside. And that's why investment committees, I think, help independent members. You have two independent, two on board, I think help you come to the right decision. I think just to mezzanine, what is mezzanine? Where does it fit? How does it work on the cap structure? So on the right-hand side at the top, you have private equity with the highest returns, but the highest risk. On the bottom, you have senior debt, lower returns, lower risk. We play somewhere in between, and I think our returns get close to private equity. So we say we're 80% of private equity, but 50% of the risk. And the reason is we have contractual returns, coupons in the businesses, so above the senior. So where the senior won't play, that's where we'll play. So it's more risky, so we charge a higher coupon. And then we capture some of the upside through warrants or equity kickers. I think there's significant downside protection because the equity players have to lose all their money before we lose money. I think it's relatively free from competition at the moment, so we are being able to price quite attractively. Pension funds and investors love it for two or three things. One is it's self-liquidating, so at the end of our term, we will value the self-liquidating equity kicker, and we'll be paid out. It has quarterly distributions, shallower J curve, and money coming in every quarter. So I think those are why it's more attractive to some investors. Other investors say, no, I'm taking the risk, I want to go for the higher returns on private equity. But you find the less riskier investor, a lot of the pension funds, and funds who like quarterly distributions buy into it. And also, I think you do get the top quartile or some very good performing private equity funds, but as we saw today, the general private equity returns is not as good as people believe. Just some of the uses of the funding, and we find this especially in Africa, where there are a lot of mid-market businesses that are very successful businesses, but sponsors or owners of these businesses are very protective over their equity. They don't like to dilute. So this has a way of not being intrusive in their business. You're not taking 40% of the business. You put a loan in there with a coupon, and you take some equity, which is self-liquidating. So at the end of the loan, you do not own any equity in the business. You've been fully paid. He's happy you've taken him from one level to the next level, and it works very well for both parties. In Africa, there's a lot of indigenization. In South Africa, they call it BEE. In the rest of Africa, they call it indigenization, where the locals need to buy into businesses. And because of the less dilutionary effect of mezzanine, this is a way to do it, for them to use the mezzanine structure or instrument to buy into these businesses. We've mentioned family businesses and who are very protective over their shareholding. And once again, expansion capital. In the mid-market, I think the banks are conservative. They don't lend the multiples that you do in the bigger banks or the bigger corporates. And therefore, that is a gap to give these people money to help expand their business and take them to the next level. So there are multiple applications for mezzanine and also multiple structures. Some people are very sensitive to rates, so you can lower the rate, increase the equity kicker, and others don't want to give away equity kicker, so don't mind paying a higher rate. We've had some investments where we've had different layers, but some layers are sitting at 30%. So instead of, they say, no, we don't want equity to give you any equity because we believe this business is going to shoot the lights out. So we say, fine, then give us an equity return on that level. And it's worked well for both parties. This is just a slide to show that we target the mid-market, and the deals we've looked at is very much, in Africa, is very much the mid-market. I think there are a lot of big private equity funds out there looking for return, looking for the big deals. But I think the mid-market is less focused on, and I think that's where the opportunities lie. The banks are giving them less money. They need expansion capital. They don't want to dilute. And so we feel that's where the opportunities lie in mezzanine in Africa. I think you've seen this a lot today, just the bigger countries where Nigeria has been re-rated. South Africa and Nigeria are still the two largest countries. And I think we did some statistics, and two of the provinces in South Africa, Gauteng and Western Cape, are actually bigger than, or come number 3 on this chart. So it just shows you within Nigeria and South Africa that they're still the larger economies. And my view, there's great opportunities in the rest of Africa amongst these countries, and these are the ones we focus on for reasons I've said before, ease of doing business, etc. So there are a lot of opportunities across these countries, but the dominant markets are still South Africa and Nigeria. So one must not be fooled. I think that the hype of the rest of Africa is maybe overplayed. I'm not saying there isn't a lot of opportunity there, but I think the negativeness of South Africa is maybe also overplayed, where I think it's still got a fantastic infrastructure, it's a huge economy, and there's a lot of opportunities and still to be had in South Africa. So just to summarize, I think what's very important is you need a strong market demand, which we feel there is for mezzanine in Africa. As we mentioned before, the need for expansion capital, don't want to dilute, etc., etc. I think it's an attractive asset class for fund managers because of the self-liquidation, regular coupons, etc. And then, of course, you need an experienced team that covers the whole of the continent, and specifically people who've worked in regions and understands regions and understand cultures within those regions. So we feel that mezzanine is a great asset class. I think it's a growing asset class, and it will take time for a lot of investors to understand it in Africa, but I think we are getting there, showing that we're on our 3rd fund already, and we think we're getting good returns, and so we think mezzanine is alive and well and a great proposition for Africa. Thank you.